and analysts say that the fundamentals of Singapore's debt and bond market remain strong, contradicting a report by credit rating agency S&P Global. Now, they tell CNA that credit risks would be benign despite slower economic growth. And that's because the U.S. Federal Reserve has indicated that it could cut interest rates soon. Brandon Tanoto with more.
The recent default of embattled water treatment firm Hyflux might be the thin edge of the wedge, building the case for further distress among Singaporean companies. That's according to credit rating agency S&P Global, even though there was only one default in the Singapore dollar bond market in 2018, down from 9 in 2017. S&P Global added it does not believe that this downward trend in defaults reflected any improvement in domestic credit quality. However, analysts disagree.
With very low high-yield issuance, we don't see default risk rising at this juncture. The current combination of still moderate economic growth and reasonable bond valuations, as well as monetary policy support overall, I think that should support fixed income returns. I think pricing in our local IG and high-yield space is still relatively attractive, so that makes our local bond market more resilient to an inflation shock or corporate defaults.
Expectations that the US Federal Reserve will cut interest rates also bodes well for Singapore firms. That's because lower interest rates means firms can take out new loans to invest in expansion, since the cost of paying back the loans is less than it used to be. It'll also allow firms to sort out their outstanding loans and stabilize their debt load. Still, analysts warn that some sectors are still more vulnerable than others. For instance, the commodities sector continues to be pressured by the weakness in commodity prices, stemming from weaker demand arising from the US-China trade tensions. But even so, one analyst says it's not doom and gloom.
OPEC countries, the major oil producer members, are going to meet in early July, and it's likely that they could reach a deal to extend the output cut until the second half of this year. So those members, they are trying to reduce supply in order to support the oil prices.
As for the property sector, while the cooling measures may weigh on sales volumes and leave units unsold, analysts reason that developers are not in a rush to sell the units and are not likely to give direct discounts, which will erode their profits.